Hi, I'm David Stein of Money for the Rest of Us, and in this video, I answer the question, should you invest or pay off debt? Last year, I got an email from a listener to my podcast, Money for the Rest of Us, from Michelle. She and her husband had heard about my show from a couple they met in Australia while they were traveling. As she listened to the episode, she came up with a question. She and her husband have over $40,000 in student loan debt. And while they save 15 to 17% of their income, they kind of have this looming shadow, as she describes it, of this debt. And she wonders whether they should not invest as much and pay down the debt. It really depends on the type of debt you have, or this listener has. There's consumer debt, which is essentially accelerating future spending into the present, and something like student loan, which is more like an investment. There's this concept developed by Gary Becker and Alfred Marshall. They're economists. It's called human capital. And what human capital is, it's the earning power that we have throughout our life. What is the value today of our earnings power, what we can make in terms of our job and income throughout our life? When you're younger, you have more human capital, more earnings power. In the case of Michelle and Scott, they took on student loans to improve their education. As they graduated with MBAs, their human capital was increased. There's a concept of asset liability matching. The asset in this case is the human capital. The liability is the student loan debt. It was okay to take out student loan debt because it did increase their earnings power. Contrast that with taking out debt to go on vacation. There we have a depreciating asset. Once the trip's done, the debt still remains. There's not a very good match between the asset and the liability. And so when it comes to deciding whether to pay off your debt, it depends on the kind of debt. Certainly consumer debt, high interest consumer debt, where there isn't really an asset there backing it up, that should be paid off as quickly as you can. But when it comes to student loan debt or mortgages where that liability is matched with an asset, the house in the case of a mortgage, the human capital in case of student loans, you can take your time to pay off the debt. Because one thing about human capital is the more you have, the younger you are, the more risk you can take in investing, such as investing in stocks. Why is that? Well, because when you're younger, if there's a huge market loss, you tend to have less in financial assets, and there's more time to recover, as opposed to a near retiree that has less human capital, less time. They can't afford to take as much risk as a younger investor. And so if you focus all of your time paying off debt while you're young, that's the time you should actually be taking more risk in terms of financial assets. That's the time by investing you can learn to become a better investor, get the experience and knowledge you need. So as your assets grow, you'll be able to be better skilled at investing. So I don't think there's an either or. You can pay off some of your debt while you invest. Focus on high interest rate consumer debt, and then slowly work off your longer term debt, be it a mortgage or home, perhaps a car, but continue to invest so you can pick up the skill and recognize much of that debt is offset by your lifetime earnings power, your human capital. Hey, if you'd like to learn more about this topic, you can check out episode 188 of Money for the Rest of Us. That's where I go into even more depth. Should you pay off debt or invest? Also, if you have any questions on this video, go ahead and leave those in the comment. And please subscribe to my channel. And if you click the bell, you'll be notified next time I release a new video. Thanks.